Ladies and gentlemen, good evening. This is Christopher Aaron. This is our 17th of February update on the price of gold and silver and related markets. We're going to be looking at the silver market, the breakout that we are seeing, the trajectory for that. We'll be updating you on the gold market as well and on the stock market in the United States, some of the interrelated patterns that I'm seeing there. If you are invested primarily in the silver market, you must follow the action in the gold market. It's not optional. I mean, it's optional if you want to be an uninformed investor. But if you really want to understand the trajectory that these markets are going in, because they're very closely related. And as you know, silver tends to lag gold for a period of days, weeks, or sometimes years. So it is in your best interest to follow the gold action, even if you are primarily a silver investor. You'll know what to expect for silver coming up that way. The other thing that I wanted to say quickly is a thanks to everyone who is watching, to everyone who has subscribed or liked or leave comments in these channels. I really appreciate that. I started this channel a little bit over 6 months ago after mostly sharing analysis with private individuals over the course of the last several years. And I just decided, why not post some of this stuff in a video format instead? And I'm very pleased with the response that it has gotten. And so I thank you for watching. I just wanted to let you know that due to the number of people that are commenting, it's becoming increasingly difficult for me to respond to every single comment. I want to let you know that I see every comment. So for people that leave comments just saying thank you or I appreciate it, know that I appreciate it. I appreciate you writing those comments. For people who leave questions, I try my best to answer as many questions as I can. And you know, for some of the times where there's more of a debate going on, I don't always have the resources to get into those debates with you on this channel within a day or two. I have a few other things going on that I'm working at. I publish articles on another investment site. I do have a subscription service. I have another YouTube service that is also going at this time. I just wanted to say thanks for all those people posting. Know that it's never that I'm ignoring your comments. It's simply a matter of the volume that's starting to come in. So anyway, I think that's a good sign for the sector as a whole, that there's comments and discussion going on this channel. So let's get right into the action. So a lot to get into today. We will start by looking at our chart of the action since the Fed interest rate hike in mid-December. Now, for those of you who are not following the markets very closely at this time, I want to rewind in your mind how much hysteria the mainstream media was making about this pending rate hike. And people were saying, wow, this is going to crush precious metals. Everything is going to crash if they decide to raise interest rates. And it was really getting out of control. So this is something that I decided to start following since that December rate hike. And we are looking again at the action from 6 major world asset classes and just updating this chart to see the leadership that gold and silver, first and second, have had relative to some other asset classes, including U.S. bonds here. So these 3 being a flight to safety. Interestingly, as most deflationists would have you believe, where the U.S. dollar should be the recipient of a lot of the safety trade, we are not seeing any evidence for that yet. As the dollar weakens just marginally, I wouldn't be surprised to see the dollar rise higher in a true crash, but we haven't seen a true crash yet. It's just been some sustained moderate weakness as we see in the stocks and commodities sector. So we will be following this about twice a month just to keep you up to date on where we stand. I believe that that rate hike in mid-December was a significant turning point in the market. If you watch the video from a couple days ago, you'll see why I believe the Fed is trapped right now. In a sense, they're damned if they do and damned if they don't. So we'll be watching this closely as the financial sector is very vulnerable right now. I want to zoom in on the U.S. stock market. I don't ignore the other world stock markets, but we have to admit that the U.S. stock market is still 25% of the world's financial equity at this point. And I'm going to draw the comparison to update this. This was the break and the crash that we saw from 2002 to 2008. The bubble that corresponded with the real estate bubble, the subprime bubble, etc., etc. And just some significant points I want to draw your attention to here. The first break that we had above this rising uptrend line here, right around the beginning of the beginning of January 2008. Notice that after this trend was broken, we failed to ever close above that trend on a meaningful basis again. And it's not that the market crashed immediately. In fact, there was a significant rally from March through the summer and a rounded sort of rally that faded into the fall, faded a little bit again before we had this crash. So to look at where we are in the present situation, we have just broken that uptrend, and we are seeing a very similar pattern here, a failure to close on a meaningful basis back above this broken trend line. Now, let's put these two charts in perspective. 2002 to 2008 and 2009 to the present. So based on this broken trend line here, this would put ourselves somewhere in this vicinity now, which is why I very strongly believe that the U.S. stock market is forming a long-term top. This is not to negate the possibility that the stock market could rise 5, 10, or 15% throughout the course of this summer. But I do not believe that this broken uptrend line will be regained on any meaningful basis on a weekly close. So something to watch very closely, zooming that in just so we can see. Here was that uptrend line, the multi-year uptrend line. Here was the break in the U.S. stock market. And notice how significant these lines are, and they are not random. And so the break occurred here, followed by this strong rebound, which hit that line from the downside, failed, fell down again, and is now attempting to rebound into that vicinity again. So something to keep an eye on here. I would not be surprised should this rebound sort of hit this line, continue to grind along the line, perhaps with a short meandering inside the line before rounding out. We're talking in May, June, July time frame. Turning our attention back to the precious metals, the reason why you are here, we saw the weakness that I was anticipating in the last video showing up starting on Sunday night in Asia, bringing us through that weakness on Monday as shown in the blue line, which fell all the way to my primary lower target of 1190 on the spot gold price. Looking at this from the 6-month time frame, we could see that weakness that came in here after that rocket blast higher out of the early 2016 lows. coming right back down to our resistance zone. Of course, if you're looking at the y-axis here, and if you are new to my charting system, you will notice that this is not the exact price of gold. This is rather the GLD fund, which has a ratio that matches the price of gold, but these numbers are not the spot price. When we get to the 1 year and greater charts, those numbers will be accurate again. This is just so we can see the short-term action here. So I would like to see this resistance zone held here on the price of gold. And I will tell you, I have a thesis for how I believe the gold market is moving forward. I need to see a little bit of confirmation left for that, but I'm going to give you my thesis now in the next slide. So we're zooming this out. We're looking at gold from 2.5 years. We had a long, linear, declining trend channel, which was broken just over this last 2 weeks. And we have found the price coming back here to 1190, which perfectly matches up with this former resistance level that was broken. So the people who were selling gold here, who were short, and who failed to close out their shorts at this low, what happened? They got trapped right here. So they were forced to buy back their shorts, which caused the price to rocket higher, $65 over the course of roughly a day. And so we want to be seeing, does this price hold? Because this is a very logical place where any remaining people who were short the gold market at 1190 back from last fall will be attempting to cover their shorts. They're afraid. They've seen this strength in the gold market, and they are now saying, should we reevaluate this thesis that gold is moving lower? So that accounts for the bounce that we saw at 1190. Now my thesis is that with this move higher and this break above the downtrend, is that this is going to form a consolidation pattern above this former resistance level as shown in black. And if that is true, what we will see is a back and forth $60 to $75 range up and down action for probably the better part of the next few months, perhaps even into late spring or early summer if you're in the northern hemisphere. And mind you, this could have a brief close below the 1190 figure. We could see 1185, maybe a brief spike down to 1180, but most of the closes will be above this 1190 figure. This is my thesis right now, and I'm proposing it as a thesis that as a technical analyst, I like to form ideas for what I think the market is going to do. And then as those ideas play out, I get a much stronger sense for the long-term trajectory that this market is forming. So if I see this consolidation forming here in the price of gold, this would be a very, very bullish signal for the next few years. It would indicate a failure to return to the former lows, and more so holding above this 1190 high on a consolidation would be very bullish. So let's watch for this. Some other leading indicators. We look at the gold mining sector, and mind you, when we're looking at the gold mining sector, even though this fund says GDX Market Vectors Gold Miners, keep in mind there are a good 5 to 10 companies that are involved in the silver market in this fund. So this really serves as a leading indicator for both gold and silver. We have seen an impulsive 65% move higher in the valuation of the gold and silver miners amidst a 20% move higher in the price of the metal. And this is absolutely a break of this multi-year declining wedge pattern that we have been seeing forming. So we saw some weakness over the last day or two, which is absolutely to be expected. I have a lot more on the mining sector in the iGold power channel. That is a free sub channel for anyone who is interested in that. I want to zoom this chart out very quickly to show you the critical formation happening here in the gold and silver miners. Of course, as a leading indicator for the price of silver itself. If you see the mining complex move higher and you are buying mostly silver bullion, you should be very happy, because that means good things are in store. Perhaps not today or tomorrow, but absolutely over the course of the rest of this year into the next several years. So this confluence of broken trend lines here that we have just seen, this trend line broken. Now, I left this trend line in the magenta color just to show you how significant this trend line was that was broken. This was the long-term trend line all the way from the high in 2011. So this trend, this major long-term trend in the mining sector has been broken. And we still have a lesser royal blue downtrend that will be broken sometime this year. But this was the critical one that I was watching for. So very good indicator. Just one other thing I want to point to your attention. Follow my mouse here down. We're looking at the volume. We're looking at the number of shares that were traded per week across the gold mining complex. A record high number of shares. And look at the increase in the volume in shares. A record high level on a break of a significant multi-year downtrend. That is a bottom in no uncertain terms. 5 times higher volume than we saw at the highs. There is significant opportunity in the sector over the next several years. Looking at silver bullion. We always focus on the spot price. Of course, if you're investing in silver, you will always have to pay that premium over the spot price. But that's okay generally, because in a rising market, which I hope everyone here is holding for a few years until the prices rise, in a rising market, you will regain that premium on the time when you sell, whether you're selling for land or for a house or for a car or for a business, whatever it is, or whether you never sell. You don't really lose that premium unless you have to turn around and sell it the next day. In that case, you're going to get hit on that premium. It's too quick. Anyway, we look at the consolidation here in the silver price that we've had over the last few days. Put this into perspective. We are looking here at the SLV fund, similar to how we look at the GLD fund, for a short-term perspective. A very nice break of this declining wedge trend line. Now, I've left this line in the royal blue color because I want to respect this until I gauge this retest. I want to make sure that we are not going to have another one of these false breakouts in the price of silver. So far, this looks good. And the longer that this price of silver holds above this declining trend line, the more valid the break. Even if it were to just consolidate here, that would be significant. Looking at our early warning indicator on the silver side, which is this company called Silver Wheaton, which I do not recommend that you own at this time. I do not own Silver Wheaton at this time, but I follow this for an early warning indicator. Notice how the silver price was somewhere back down in here, and Silver Wheaton is bumping against these highs from October. So Silver Wheaton at the moment is stronger than silver, which tells me that silver investors are expecting higher silver prices in the near future. So we'll be watching this signal very closely. Switching to the silver spot price on the 1-year time frame, you can see that nice breakout that we've had from the declining wedge pattern. And once again, the longer that this price holds above this broken line, the broken declining line here, the more valid this breakout will be. Even if the price were to flirt with this line from the upside, even if it were to just skim it like that, perhaps back down to 1450, still a valid breakout signal. This was one of the possible trajectories we talked about 2 videos ago in the silver analysis. So still a valid breakout here as long as this line holds. Now, that leads me to the conclusion that we have seen a very long-term bottom in the price of silver. Right here in the 1360 region. As long as this line holds here, I'm calling this a very long-term bottom. When we look at this same pattern for silver on the 5-year time frame, I know a few months ago this sort of looked a bit skeptical. It was, okay, what is this pattern that he's talking about, this bottoming wedge pattern? Well, we've seen the break of it now. And now the next thing that you will see is the holding of the line and the beginnings of the movement away from the line on the broken side. That is what I'm looking for as a technical analyst. We talked about this a few months ago, the breaking of the downtrend in silver versus the rest of commodities. We saw that on the very first slide, confirming that here on this slide. Very good signal for silver to be breaking that downtrend. So I just thought I would bring this up as a final point for today's video, which is we see a lot of people make reference to technical analysis, and I think this is what turns a lot of people off to this form of analysis when they are first presented with it. You may see something like this. This is a typical form of technical analysis that you would see. This is the exact same chart of silver that we just saw in the last slide, but with the MACD, the moving averages, the Bollinger Bands, the exponential moving averages, the accumulation distribution line, the stochastics, all of these other indicators. I have found over the years that 90% of these indicators are absolutely worthless, at least as far as me making money in these markets goes. That is my opinion. If they work for other people, that's fine, but they don't work for me, and they just confuse things. I can't make any sense of this kind of chart. The type of a chart that I can make sense of is something like this. It may look basic to some people, but you know what? This is what they would call Occam's razor, which is all things being equal, the most simple answer is often the correct one. So in this case, we're looking at the most simple form of analysis that we can when applied to the technical analysis of the precious metals markets. And I am saying that we have hit a long-term linear rising trend line from which a significant bottom has formed. This is not to say that the price is going to skyrocket immediately, but rather over the course of the next 5 years, we will be looking at making another attempt of this still unbroken line from 1980. Silver being one of the only commodities in the world still below its 1980 peak. And what will account for that move? It will be regular people recognizing once again the monetary component in silver. That will be the psychological shift that we see for the price to take out $50 and then move higher. not this year in my analysis, over the next several years to come. Thank you for being with me. I'll see you on Sunday evening.